What's up guys, it's James Allen, the Out-of-State Investor, and today I wanted to share with you my honest opinion of just how much I expect the prices will correct in this housing market correction. Now we've seen YouTubers talking about a 50% housing crash on the way, how it could be the biggest housing crash of our entire generation, and while I made it very clear that house prices are going to continue to decline from where they're at now, today I wanted to share with you my actual predictions of how big of a housing market correction we're going to see, how much we're going to see house prices decline, and particularly which markets are going to be hit the worst. So before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this, and with that said, let's jump into it. The housing market is finally seeing some major price adjustments to the likes we haven't seen really since the housing crash of 2008. Now yes, 2008 is the year of the Great Recession, and although we're not experiencing the same problems that caused the Great Recession in 2008, we have a serious affordability crisis to the likes that we haven't seen in over 38 years. Now this affordability crisis has really been triggered by mortgage rates skyrocketing the way they have recently, and if you really just went back to August 3rd of 2021, you'd see that the average 30-year fixed mortgage rate was sitting at about 2.78%. Recently, we hit a new high of 7.37%, which means that we've seen growth of over 4.6% in mortgage rates in just over a year's time. So when you combine the fact that mortgage rates have gone up so much since then, and prices are still higher than they were back in August of 2021, you have the biggest affordability crisis in nearly 40 years. So that's ultimately the cause of why we've been seeing these house prices declining nationwide, and unfortunately, based on what we can expect in the future with mortgage rates continuing to climb in the future, it's only going to continue to get worse as far as affordability is concerned. So just how bad are things going to get in 2023? Well, for one, we can definitely expect the Federal Reserve to stay aggressive in its monetary policy, and remember that that's a very important thing because all of this connects ultimately to the future of the real estate market. You see, in a nutshell right now, the problem starts with inflation being sky high. It continues to be a problem, and that causes the Fed to continue to stay very aggressive in its monetary policy because that's the way that they combat inflation and help bring inflation levels down. That in turn causes mortgage rates to keep going up. That causes affordability to go down, which pushes more buyers out of the market, lowering demand for buying houses, and unfortunately that causes prices of housing to continue to plummet. So ultimately my prediction is that the Fed will stay aggressive, although I don't think they're going to wait it out until we reach 2% levels like they say we are. I think they're going to settle for 3 to 4% levels, and even that will probably take us till at least late 2023, maybe early 2024 until we can reach those kind of levels. So what this basically means is 2023 is going to be a very painful year for the housing market because ultimately I think the Fed is going to continue hiking interest rates. I think we have another interest rate hike coming in December, probably another 0.5%, 0.75%, somewhere around there. And then I think we're going to have several rate hikes coming in 2023. What that translates to is we can anticipate that where mortgage rates are at now, around those 7.3% levels, is going to continue to go higher. And my personal prediction is that we're going to see mortgage rates go into the 8s, maybe even the early 9s. Now, for every percent that mortgage rates go up, buying power goes down by 10%. So by going up to 9% mortgage rates, and we're currently around the 7% levels, that means that buying power could decrease by about another 20% from where it's at today. And keep in mind that we haven't even caught up, the sales price numbers have not even caught up to the current 7% levels because the homes that are selling right now are based on the homes that were listed back when interest rates were back at 5% levels. I'm also predicting that the Fed is going to naturally induce an economic recession as a result of it fighting inflation because as they fight inflation, naturally we're going to see less consumer spending take place, which hurts companies' bottom lines, and that will lead to more job layoffs taking place across the nation. And we're already seeing signs of this really with companies like Meta, companies like Twitter and Lyft and other tech, especially the tech companies, are really seeing thousands of jobs lost across the country. Now this will translate to the housing market because as people get laid off, as people get their hours reduced, that's going to take take more and more would-be buyers out of the housing market as well, reducing demand even further than where it is currently at. It's also going to force some people to sell their home as they may not be able to afford their mortgage payment anymore, and so that will force more sellers onto the market. This is exactly what's going to break the gridlock between buyers and sellers, as we've recently been talking about this, that there's an ongoing battle between buyers and sellers, where sellers, homeowners really don't want to sell their homes because they're trading a 2%, 3%, 4% rate for that of a 7% rate. Doesn't really make sense, and they know there's very weak buying demand right now, so now's not a very ideal time to want to sell your home, especially when you have to pay probably twice as much for an equal level house. Whereas buyers, many buyers don't even have the option to buy because they're getting priced out of the market as mortgage rates keep skyrocketing at a very fast rate. And so when they go to qualify with their lender tells them that, I'm sorry, you just don't qualify for a house anymore. So that's just taking more and more buyers out of the market. And so as a result, we see housing transactions, the amount of homes that get sold ultimately, are continuing to decline. Now, some people are making the argument that they think that house prices won't go down that much further because ultimately, although buying demand is going down, the amount of active inventory or active listings on the market continues to go down as well. And of course, with less supply on the market, that puts more upward pressure on prices. However, with that said, what we're seeing is that buying demand is going down even faster than active inventory is. And so as a result of that, we're continuing to see the months of supply continue to go up. And we're at a months of supply currently of about 3.3 months. Now, that's the highest it's been since the beginning of the pandemic in early 2020. And it's already about doubled from just where it was back in January of this year. So we're seeing it continue to go up week over week over week. And it's going to get worse from this point on, especially as mortgage rates continue to go up, especially as the economic crisis starts to hit. And I'm going to explain this later, but it doesn't even require months of supply to go up in order for us to see some price changes take place. I'll explain that in just a minute. So it's going to be a painful year, but just how much do I think the prices are going to decline in this housing market correction? Well, first let me say that I don't believe we're going to see a 50% nationwide housing market crash take place. I don't think it's going to get that bad, and I don't think it's going to be as bad as the 2008 housing market crash that we saw, because ultimately there's not this widespread trigger forcing so many people to sell their homes. You see, back then you had the ninja loans qualifying people for mortgages that weren't worthy of being qualified. You had people with teaser rates that all of a sudden their rates jump up significantly, and now all of a sudden they can't afford the mortgage. And so that really caused so many people to have to list their home on the market. It flooded the market with inventory, and that ultimately led to a massive housing crash and to a massive wave of foreclosures taking place. So that's not what I think is going to take place. Ultimately, I think that this housing market crash remains an affordability crisis, and I do think the affordability continues to get worse, and so naturally we're going to have to see house prices to correct to what people can actually afford to pay for a house. Now, we talk about forced sellers and how it may not be as bad as 2008, but I do believe that there are definitely going to be some elements of forced sellers in even this market, aside from the economic recession. But even when it comes particularly to builders, investors, and iBuyers. You see, unlike the typical homeowner, these people have to offload their inventory. If you're an investor and you have a hard money loan that's going to mature and you're trying to flip the house, you're going to have to offload that house, and you're going to have to reduce price to sell it. If you're a builder or an iBuyer and you have a ton of inventory the way these builders and iBuyers do, you're going to want to sell sooner than later, and that's why we're already seeing major incentives for builders coming in place, major price drops take place, and people taking losses on their purchases that they made, especially the iBuyers. So when these sales take place, and remember, these are forced sellers, so they're going to drop the price more than maybe the average typical home buyer is willing to, and so they create new comparables as a result. So if they had to cut their price $100,000 to make sure they could offload this thing, get this thing off their books ASAP, and they had to take a haircut to make that happen, that becomes a new comparable for the rest of the housing market to use. So if you have this new build that was trying to go for $600K, ended up selling for $500K just to fire sell it and get it off their books, that $500,000 comparable is really going to hurt the other house that's on the market that they're trying to sell their home for $550, because how are you going to sell your home for $550,000 when you have a brand new build that just sold for $500? Now, with the iBuyers, I was actually interested to look into some of the data of what's going on with iBuyers, and I saw this tweet come out that actually had some really good information information. They've talked specifically about the Phoenix market because there's a huge concentration of iBuyers in the Phoenix market, which is one of the reasons why I believe that Phoenix is definitely going to see some major corrections take place. But let's take a look at this tweet right here. Jason Lewis wrote, "Here's what we know about top iBuyers in Phoenix. They hold close to $1 billion in homes right now." That is massive. And I've even seen that with Opendoor, they have about, just that one company has about 10% of the entire listings on the Phoenix market when it comes to single family homes, that is. If they sold their active inventory today, they would lock in $100 million in losses. They are slashing prices by 2% every 14 days. So you see, those are the price drops I'm talking about. They're consistently slashing prices because they have to offload this inventory. These are forced sellers. Demand has dried up at current rates. This could get ugly. And then it goes on to show this chart over here. It says the percent change purchase price versus current asking. So basically, what the iBuyers purchased the property at versus now what they're currently asking for the property. And you can see here that in Atlanta, they have a positive here, but in everywhere else they're at, you can see it's a huge negative, especially in Phoenix. They're at a negative 10% from what they purchased the property at to what they're asking for the property now. So basically, a lot of these iBuyers are in serious trouble and they're going to take massive losses, and they'd rather take them now than later because later is only going to get worse. So with all that considered, how much do I think that house prices end up going down at the end of all this? Well, right now we're currently down 8% from peak levels, and that's a nationwide number. So what I think is going to happen when you factor in the economic recession, when you factor in these home builders and how they're forced to sell off their inventory in the iBuyers, I think that nationwide, I think we could see around a 25% correction from peak levels. Now, some markets are going to do better than others, and some are going to do worse. So which markets do I think will ultimately do the worst in the nation? I think personally it's going to be many of these pandemic boom towns that we saw. Markets like Phoenix, Boise, Idaho, Austin, Texas, Las Vegas, Nevada. After that, I think it's going to go to a lot of these unaffordable markets like San Jose, like Seattle, and Los Angeles. So for those markets, what I think we're going to see is I think we could see corrections in the worst levels up to maybe 30 to 35% from peak levels. Now, all of this is assuming, of course, that the Federal Reserve continues to stay aggressive. If they don't and they do an early pivot, well, that changes everything and all bets are off. But really, I don't believe that's going to be happening anytime soon. I think that we're going to fight inflation. Although I don't think we'll reach the 2% levels, I do think we'll pivot probably around the 3 to 4% levels, which means we're still at least about a year and a half away from that point. So with that said, I hope you guys enjoyed today's video. If you did and you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.